Ladies and gentlemen, welcome to Capital Flow's live stream. We're doing a live stream every single day at 8:30 a.m. Mountain Standard Time, breaking down the macro regime, all the different changes in markets, and doing it from the framework and perspective we're using every day to take risk. And so that's our entire goal. I'm going to continue laying out all of that. We'll have a lot of really interesting things today in terms of how to think about the dispersion between semiconductors and software, how that connects to the geopolitical situation. What should you be thinking about as we're kind of coming out of this entire meeting with Xi and Trump, and then how all that connects to NVIDIA earnings. And by the end of the stream, you'll have a really good understanding of all the moving parts for that, the dispersion taking place in software, why some stocks are ripping. And in my view, if you get some of the signals today and you begin to integrate those into your daily process for looking at markets, you're going to understand kind of the next move that begins to shift in markets. While I think, you know, the narrative of the day, the idea of the day is that the only thing that matters is, you know, Leotard's positioning and what he's going to be doing. And so we'll be covering that. So thank you for being here today. James, how are things going? How was the weekend?
Good, crazy weekend full of kid stuff. Still trying to stay locked into markets. I feel like, one of my skill sets is understanding the broad feelings out there. Not that I'm some expert in it, but there's a lot of confusion, a lot of mixed like bags of some people who are very bulled up, very euphoric, and some people who are very scared, very bubbly, whatever. So it creates this whirlwind of, under like riptides and surface level stuff. And it's really interesting and hard to look away. It's like staring right at a car crash, right?
Yeah, absolutely. I just think this is one of the best parts about markets is so many things are changing and they're so fast. And I think that's disorienting for some people, and other people look at that and they go, okay, I can run at this cadence, right? And it's more exciting than it is like, oh, well, yeah, it's just so funny how the 2010s were just so slow in one sense. It's like, oh, there's deleveraging in the economy, no inflation risk. The Fed's doing some weird stuff here and there. Software's ripping to the moon. And then COVID happens. And ever since then, there's just something wild that happens every single year.
Yeah. And it's funny because everybody calls them like black swans in a way, and at this point, it's like these really crazy once in a lifetime events are not so much anymore. So I think we need to find some sort of new term or new outlook on like what's actually the crazy right or left tail or something.
Yeah, I think it's I love the memes and tweets online now where people say stuff and it's just like, oh, this is so insane, this and that, and then people just comment like skill issue.
That's right. Like, well, I mean that's the thing is like if you want to perform these days, you still can do it. Like there's still edge out there. There's still ways to think through all this stuff, but you have to, it's like, to me, it's more like a sport than ever. And you have to treat every part of your life like you want it. And you can't just do the execution side. You need the kind of whatever you want to call this, foundational learnings, that kind of side that you take, and then the execution mindset that you take, and then you got to go into your physical body and you got to surround yourself with the right people and doing it in the right way, and then you got a real good chance at something really special. And I think too many people are so bear pilled on everything that thinks like, oh, it's just impossible to do great things here. And I think we both think the opposite, especially moving forward.
Yeah, absolutely. One of the things, everyone, we're going to cover in today's stream is I have a bunch of ideas that, I'm going to cover in today's stream. And on the software side, AI side, the flows of capital, how to think about interest rates, and I have some, really great breakdowns that, if you guys are watching this, as a reminder, every single slide that we go over, every single breakdown that we go over will be sent out at capitalflowsresearch.com. So if you're not there yet, go there, be a subscriber there. Every single thing that we go over is going to be laid out there. Every single slide deck, live stream report, you'll get the daily live stream links, and then you have all the paid research there as well. But today, the specific thing that you will get is the breakdowns I do, especially on some stuff that people aren't talking about as much after this change in TSMC, Taiwan, US and China, Trump and Xi, and then also how it connects to NVIDIA earnings this week. You'll get all that. But then also, James has pulled together a couple of other really key thoughts on how. What in the world?
I think if you're wondering about the comments, whenever I comment, it throws in the same comment under your name. So
Okay.
I was wondering the same thing. Yeah.
Sorry, I was.
Don't worry,
like,
we're not hacked. It's not a Russian hacker.
I was just like, this can't be.
So we'll have to figure that out.
That's fine.
It's
totally cool. It's totally cool. As long as it's not someone else. So James has a breakdown today that is going to pull together a lot of these ideas and connect it to why exactly two people can have the same information and yet have two dramatic different outcomes when they are put in a situation where they need to act under uncertainty with that information. And that's the thing that he's going to talk about and go over. And so if you want that entire breakdown, that'll also be on my website as well after this. And he'll cover that in today's session as well. But the place that I want to start is we know that over the weekend we had some things shift marginally. Equities are barely down, but the rates are basically still at their lows, or bonds are still at their lows. And this goes back to the idea I've been laying out over and over. If you've been watching on the Twitter page that I have or Substack or whatever it might be, the idea is that inflation risk is greater than recession risk. Stocks over bonds. I've been tweeting this for, and laying it out in research for months and months now. And we're seeing it in real time. And then the other interesting thing that we're going to go over today is remember that in February, I published this exact report where I talked about Palo Alto, CrowdStrike. These cybersecurity companies were basically being sold indiscriminately because AI is disrupting security. Everyone's like, hey, guys, the new model by Anthropic is going to completely change how cybersecurity works. And we got everyone net short these names. And then what happens when that exact thing takes place? You got Palo Alto ripping to new highs. You have CrowdStrike also ripping to new highs. Listen, I get that if you have some shifts where you have, things like Intuit down at lows, I mean, it's stopped going down. Where you have this like tax software play or Adobe, those names. I mean, I've not wanted to be long Adobe in a long time. Those plays, yeah, it makes sense how AI is disrupting them. But now what we're seeing is a lot more dispersion, where some names are doing well, some names are not doing as well. And what you want to do is take all of those names, pull them together, and connect it to positioning the shifts that we are seeing, and specifically connect them to the earnings catalyst that we are seeing this week. Because what you have to realize is that the same guys who are trading the flows in software are the same guys that are going to be trading NVIDIA this week that is going to have earnings. And so you need to understand the context first and the positioning around these flows. So again, here is the slide deck. You can get all of this. It'll be laid out on the website right afterward. This is the SMH ETF. It has been melting straight up for the last 2 months, ever since the March lows from the geopolitical shock. And what you will notice is that in blue, you have implied vol rising. That's critical to note because that shows the option market and traders in the option market, as momentum is increasing, they're panic buying and they're having to buy calls to get exposure. And so when you have implied vol rise with price, it's very much of like a commodity market. If you notice, the same thing basically took place with crude, where you had call skew blowout because people had to buy calls. A lot of times the S&P 500, if you think about the S&P 500 and you think about the VIX, typically the VIX only goes up when the S&P 500 goes down. And why is that? It's because the majority of positioning is net long the S&P 500, which means that the primary way that they hedge is to the downside. They buy puts to hedge their exposure. And so you'll notice that you have the spikes in the VIX when the S&P goes down. Now, all of that shifts when you begin to have positioning shifts. So for example, if you, what's the, James, what's the ticker on TradingView for crude? I always forget on TradingView for vol.
CL1. Oh, OVX.
Yes, OVX. OVX is the vol ticker for crude. And what you will notice is that the majority of the time, sure, you have it spike when crude goes down, but the opposite happens as well. When you have it move to the upside, because positioning, it really depends on the situation. It can move up or down. And so you can notice crude moves up and vol moves up. Why is that? Why doesn't it work like the S&P 500 where vol only goes up when crude moves down? And the answer for that is because when you have a commodity market, you have people positioned long and short depending on what type of player they are in the market. Typically for the index in the S&P 500, the majority, functionally everyone, is positioned net long because it's a risk asset that goes up over time. A commodity market is very different. And so those are the two ends of the spectrum for how these shifts take place in vol. Now, when you begin to have retooling of the economy, you begin to flip all the rules in the script for how this works, which is why when we go to things like the semiconductor space and we see call skew blowing out on equities, part of that, yes, is a bit of a squeeze in positioning and you're panic buying a little bit and it's a bit of chasing. You know, you had that same thing kind of happen here and you had vol up and then you had the price up, but then we consolidated. We didn't, move just right back down. A lot of these moves up have vol moving up in the same time. And in green here, this is just skew, 25 delta call minus a 25 delta put, which just shows what are the out-of-money calls versus the out-of-money puts. If you're trying to simplify that, just think positioning premiums net long or net short, or basically traders are betting on more upside versus downside in the option market. That's what this green line shows. So when you have retooling of the economy, especially on the demand side with all these AI names, you almost have these different stocks function like a commodity. And so once you have all these moves to the upside, again, remember, people have to be long these names or long the underlying fundamentals in them, or else they'll get disrupted and they'll get thrown out of business. It's functionally the same thing in the commodity market, where if you don't have the right exposure, your business could just get completely wiped out overnight. And so people are forced to buy. It is a constraint. It doesn't matter if they're conservative or whatever it might be. I mean, you just think about, your own life. And when you say like, well, I have to go to the store and just buy food, it doesn't matter the price. And it doesn't matter how conservative of a value investor you are. You got to eat, right? Last time I checked. And so same thing with gasoline and every other hard commodity. And people have thought about software as this intangible commodity for so long, but now what's happening? Software and hardware are in the process of converging. And I think the live stream that we're seeing on Twitter with that robot, and you have it, by the guy, I think everyone has seen that, where you have the robot doing the package work, and then you also have the guy doing the package work right next to them. That's like the clearest form of how low skill labor is getting replaced. Now, that just means that that guy who is doing it, he needs to start upping his level of competency, and he'll probably get paid more money if he does that. So if you move up the chain of skill, you'll actually get more money, but that requires more agency. And so if you are going to decide to make more money, that's a decision. It's not just, your lot in life. If you are going to decide to do that, you have to align yourself with the retoolings that are taking place. Those things in the underlying economy are tangibly reflected in charts like this, where incrementally you have things where you have vol rising and the price rising at the same time. That's directly linked to this retooling idea. Or else, the SMH ETF would just be moving in the same way as the S&P is with the VIX. So That's on the hardware side. So you think about the SMH ETF is all about semiconductors. Now, the other side of tech, so just think about it. Tech is broken into two sectors, hardware and software. This ETF is hardware. It's all the hardware names. This ETF, IGV, is all the software names. It's part of them are being disrupted by AI. And now what we're seeing in the software sector is specific ones are unwinding, and they are, if you saw the days where SMH is down a little bit, IGV is up, that's equity long short positioning beginning to adjust. And what we're seeing in the software sector is a shift where the winners are emerging and the losers are staying suppressed. And you'll notice that on a broad index basis, you have had vol still remain elevated. So this blue line is showing implied volatility. It's still elevated at the same levels it was at in January. That's pretty insane overall. But and why is that? Basically, the outcome for software is so uncertain right now. It could do incredibly well or it can do incredibly poorly. And people don't really know what's going to take place. Are they going to adapt, integrate, and then rip back up to all-time highs? A lot of the tech bros are now saying like, oh, well, we're not rating software companies in the same way as the past and blah, blah, blah. Like they've all kind of bought the Kool-Aid. And I'm sure there's a lot of companies that are totally getting disrupted and they're totally going to get cooked. But what you have to realize is that there are going to be winners that emerge. And when you think about broad software, yeah, sure, it's probably not going to, as a sector have the same multiple, but sectors change, right? Like you always have names cycling through the index. And so when you go through, I'm going to connect this with NVIDIA in a moment, but this is the software sector itself, basically the IGV ETF in the S&P 500, all the software names in the S&P 500. What you'll notice is that there are a ton of names. So I've showed the 1 month returns right here. So basically from the lows, there are a ton of names that are doing incredibly well and they're up on a 1 month basis right here. So basically half the names are up over the last month. Then on the downside, you have a lot of names that are just still sitting at lows and just waiting around. Now, when you look at those names, again, that goes back to when you have two of the major names in there. Let me go through right here. Palo Alto Networks, CrowdStrike. Again, those are two names that I talked about in the reports that I published in February about, I don't think that these software companies that are doing cybersecurity are going to get disrupted. Now, Palo Alto and CrowdStrike were being sold indiscriminately with the entire sector. And so that is an indication of what is happening and how you should think about it. And so what you want to think about now is, okay, well, how are those flows going to shift? And you want to be watching all of these names. Where is right here? You want to be watching all these names. And again, you can get the entire list of these. I'll send out this entire slide deck. It's going to be available afterward. And the two names, we'll go to Datadog and a couple others. But the especially on a cybersecurity basis, this is beginning to shift flows. You have Datadog rallying, which showing one of the most important things, and it's not just in the name, but one of the most important things to recognize during this period of time is that all the AIs that we have right now have been trained on what? Public data. And that means that their greatest limitation is connected to this entire data side of things. And so once you begin to integrate that into all these companies that have proprietary data, and those AIs get trained on that, then you begin to see the winners and losers in the software sector. And if they can integrate with hardware and have even greater, think about the adoption cycle of just self-driving cars with Elon. The car that is self-driving in, one state, the car that's self-driving in Texas can help the car that is self-driving in Florida just by all of the things that it's learning every single day. And so all of the things that one car or one individual or whatever it might be, all the data points that it learns every single day and iterates around and makes mistakes and shifts and increases and decreases its aggressiveness or whatever it might be. All of that flows now to the process of learning over and over. And now the learning on a private data set becomes exponential. And that's why you can have something so exceptional. Just think about a comparable process. Maybe it's not going to be as high quality as what Elon's doing, but it's going to be exponentially better than what we have now, where if you have all these AIs get trained on public or private data, and you begin to have that adapt more, then you can have more specialized agents to help you make really good decisions. And then you'll say, well, I don't want to go to Claude for this. I want to go to this other AI, or I want to buy this plugin or description or overlay that connects to this other company. And so that's why you have a lot more dispersion. We have CrowdStrike and Palo Alto beginning to shift like this. Now, there's fundamental reasons as well, but you want to connect those to the larger macro picture. Now, the entire situation between hardware and software is all gravitationally connected to one name, and that name is NVIDIA. What you will notice is that NVIDIA has been rallying for years and years now. It's had incredible earnings announcements over and over that have gone incredibly well. And what we have seen is that it's moved with the broad market, but generally speaking, when we move into earnings announcements, it does incredibly well. And so the rallies that we have seen over and over have continued to reflect that. And the demand side we see for NVIDIA is, people are going to say, well, NVIDIA is going to go up over the next 10 years or 5 years because of all the demand. All of us know that. It's priced in, right? All we're trying to do is say, okay, if you're holding NVIDIA for 10 years or something like that, or you're just saying, like, I don't really care about anything else, then you don't really probably need to watch earnings today or anything like that. You should just hold it and not really think about it. And is it probably going to be higher in 10 years? Yeah, probably. But if you're trying to develop an edge and have excess returns and be able to understand how this fits into the larger macro picture for trading, then you want to begin to understand several key points. And the first point for that, let me pull up the chart for this. The first point for that is on positioning. As we have moved into, again, remember, we have the entire SMH ETF, vol is rising with it, and call skew has moved up. NVIDIA is one of the names in that ETF. And you'll notice in blue here, you have NVIDIA implied vol rallying on the rise here. Again, very, very connected to the fact that it's almost trading like a commodity. And, people will a lot of times think that when you have these types of moves, they're really bad, but it's very indicative of how the hardware sector is functioning right now. Now, the key thing to note is that this red shaded backdrop right here and this line right here is call skew and put skew moving and pricing the premiums and discounts. So you'll notice that, this move up that we had here when vol rose, you had call skew rise when the price was rising, and then you had the opposite happen on the downside. This is the first time in basically a couple years where you've had call skew actually turn positive, which means that you have a lot of traders paying a premium for calls versus puts in a pretty significant way than we have in the past. That tells you that people are positioned pretty aggressively into earnings. Now, the whole question you need to be asking is the changes that we are going to see this week in NVIDIA earnings going to surprise consensus and positioning, or is it going to disappoint it? Because if it disappoints, you could have a decent amount of positioning unwind. And again, NVIDIA as a whole is the gravitational force for the entire software and hardware sector, which means that it is setting the pace for kind of the entire race that is occurring overall. So that begins to frame the fundamentals for all of the changes in earnings this week. Everyone cares about the changes in NVIDIA overall. Now, what we want to do is we say, okay, I understand this bigger picture. I understand how these macro forces are taking place. I understand the positioning in software versus hardware. Now, let's connect that to all the catalysts that we are going to see this upcoming week. And then we'll connect that to the geopolitical situation as well. Here's a breakdown of all the earnings we're going to have this week. And if you want this deck, again, it'll be laid out on the website. Again, if you're not already on the website, it's all laid out here. You can go to capitalflowsresearch.com. Every single article, every single deck that I share will be laid out here. And you can go through all the educational primers right here. These have every single thing that you need to know on macro and markets. If you feel like this is a bit intimidating and you're just trying to get your head and kind of your hands around the entire macro picture and all these flows that I talk about, all you need to do is just become a subscriber here, just become a free subscriber, and just start investing a little bit every single day and go through the slide decks, show up at the live stream. Again, we're doing these streams every single day, 8:30 a.m. Mountain Standard Time. All of these different changes are laid out in all these reports, and you can just scroll down, go through the overview of the recent changes or the overview of the live stream, and then you can go to the deck right here and download that and go through it yourself. All you need to do is show up, go through that, and go through the deck. Just start there. If you can start there, that will give you the clarity for the next step that you need to take, whatever that might look like in your life. And if you're trying to understand what that looks like in your life, you can ask a question in the chat section and say like, hey, I'm going through all this stuff. Here's how I'm trying to understand it and connect it to my life. And then myself and James will begin covering that in the actual live stream, and we'll answer those questions.
And just so you guys are aware, I'm going to be looking at the questions most of the time here. And for the ones that are relevant and solid, I'm going to be starring those, and we'll try to cover them before the end of the stream. So just know I am keeping watch there for that. So go ahead.
Awesome. And then if you guys are here, if you guys can reshare this on Twitter, that would be super helpful. And then if you guys are on YouTube or wherever else you guys are watching, explain where you're at in the comment section so we can continue improving the live stream. And, we had someone in the comment section, I think, what was it, last week or Friday, basically say, oh yeah, I've showed up to every single live stream without fail for 2 weeks straight.
Multiple people are doing that.
Yeah.
That's awesome. And I'm glad that it's helping develop. Like, think about the story and, maybe added conviction they have to their portfolios or whatever it may be by showing up every day and kind of building this whole personal thesis. I think it's awesome.
So let's dig into this a little bit more on building that kind of idea of conviction. So again, this will all be laid out. It'll all be on the website afterward. It's all free. So earnings week for this week. The kind of backdrop is we have the entire China tariff holding pause. We have hyperscaler CapEx. So all the money that we're investing, there's functionally $1 trillion going into the economy right now that is, getting pushed into all of these changes. And one of the key things that I'm always trying to explain to people is that it's not just $1 trillion that's just flowing into the economy and going everywhere. It is almost $1 trillion going to the most asymmetrical linchpin of the economy that impacts every other part of spending, goods, services, and decision making. So it'd be one thing if we're just like, oh, we're going to build a bunch more brick buildings, but that's not what's happening, right? We're retooling the linchpin of everything. And so the questions for AI, especially NVIDIA this week, is where are we at with the AI CapEx durability? Because NVIDIA, and also, if any of you guys are watching, TSMC, they have monthly prints instead of quarterly for all of their fundamentals or some of their fundamentals. So you don't have to wait for earnings. A lot of guys in the CapEx space, or the semi space, or watch those numbers. I mean, they're no secret. Everyone knows about them, hopefully. If you don't know about them, you should be watching them. But the NVIDIA side is the anchoring point for everything. So that's one thing for this week. We also have some consumer earnings this week, and then also tariff pass-through questions, and then we also have some housing changes. And Tuesday, we have Home Depot, and then before the close, key insights. Wednesday, we have TJX companies, Lowe's, Targets, ADI. After the close is NVIDIA on Wednesday. That's going to be the most key one. We have Intuit, so there's some software, right? I actually think one of the things I talked about is that Intuit could probably rally a little bit off the lows, and especially as we kind of get out of tax season and some other things change. That could be kind of interesting. And then on Thursday, you have Deere & Co., Walmart, Ralph Lauren. After the close, you have some more software names, Workday. That's going to be a key one to watch. And then several other names here. And then you also have Williams Sonoma, every white girl's favorite place to shop. Probably want to be watching that. Okay. And so the idea is that there is a connection and a clustering for all the earnings this week. And just as a reminder, anyone who is at a hedge fund moving significant size, they're watching all these and they're probably trading most of them. And, when we think about where we're at with this week, AI hardware stack, we have several names for the ADI, Keys, and ND Nordson. Those are all names that you want to be watching around the NVIDIA print because they are going to be connected at the very least in positioning. Because if there is some type of unwind that takes place around NVIDIA and that positioning unwinds, that is going to impact and reverberate across everything, especially the software sector. Especially if you have a lot of people net long NVIDIA and net short software names, you could actually have, if NVIDIA gets sold, you have to have short covering in some of those software names. And so that's the hardware stack. You have a lot more consumer names this week. And that's how you want to kind of map all of these. A lot of them connect to, Walmart is the largest employer in the United States. So all of us watch Walmart earnings pretty closely because when you see changes like this, where you have, Walmart ripping like this and they're continuing to move up, that is a massive change. Can I talk about, let me think. Hang on one second. I'll have to have, man, I was talking to, I think, James, you know him. I was talking to a friend who works there, and we were talking about some changes at Walmart, actually, and how they're shifting around some of these gas prices, some other stuff. I'm not sure. I'll have to ask him if I can share what he told me publicly, and then maybe I'll share it on tomorrow's stream or something like that. Really interesting.
Walmart inside baseball, sir. Wow, that's next level.
I'm not sure if I can share it with. Have you even stepped foot in a Walmart store recently?
No, I'm more of a Target guy. So
more of a Target guy. You know what? That's the exact white girl response that we need.
Never doubt the 35-year-old woman consumer that goes to Target. Never doubt that is a resilient money printer.
That is more resilient than male spending for sure. We actually have Target. I think do we have Target this week actually? Yeah, we have Target. It's actually kind of funny. I have here at the bottom, let's see, consumer spending, and you basically have like Walmart versus like Target and Ross. And it's just like, well, which ones are going to outperform? And it's right here. Target. Well, I don't know. It's not doing that well right now. Maybe this doesn't reflect the upper K. Yeah, it's not looking good.
Maybe they're shifting to Walmart.
Maybe that's the key. They're silently, they're just not posting about it on Instagram. They're taking it and they're just trying to keep it on the down low.
Don't let Instagram fool you, right? That's where the highlight reel is, but not representative of real life, right?
There it is. I mean, the Walmart earnings are kind of saying it all. But that's on the labor market side. One of the things that you want to watch is when Walmart, when they're rallying like this and they're moving like this. One of the things, especially because Walmart, one of their key inputs for costs is oil, because they transport so much stuff, right? Obviously, they have cost of goods sold because they sell durable goods. But one of the key expenses is they're one of the only ones that have their own private fleet of trucks, and trucks are one of the main, they are one of the largest consumers of oil. So if you think about something like Jets, right, the Jets ETF, the biggest expense for any airline is fuel. And so when fuel costs go up, that changes their prices, which basically changes demand. And that's why their prices, move in lockstep with oil a lot of times, because it is one of the largest kind of inputs. I mean, it's such a tough business to make money in either way, because you're basically getting screwed on oil prices and you're also getting screwed on labor, because it's so tough to have pilots, especially post COVID. I think if you talk to anyone, it's just it's so challenging to have enough pilots who haven't retired and want to come back in the labor force and stuff like that. And the pipeline for pilots is so long right now, so that they have to pay people more. And so that they're getting squeezed on that side and also the energy side right now. So that's kind of an interesting thing. But back on earnings. So the way that you want to think about this is, I have all these breakdowns for how to think about all of this, and you can go through this on your own, which I would encourage you to do. It's an entire breakdown where I explain how you should think about the company, how it connects to this week, and what are the key things that you want to be watching as it connects to the larger macro context. But on the NVIDIA side, if you hopefully NVIDIA designs GPUs that train and run virtually every AI model. They sell chips, full service systems, networking gear that hyperscalers buy by the tens of billions, single most important company in the AI CapEx cycle. The idea here is that gross margins are 75% guided. So that's what they've been saying, and that's what we're going to be watching. But the other thing here is all about the China situation in Taiwan, because Jensen and every single tech exec was just in China with Trump and also Xi. It's actually funny if you go see the videos of all of their meetings and dinners, you can basically tell that all the servers were basically like CCP secret agents who are just like trying to gather information and go through all of the different things that they were doing.
No, don't get psyoped. Don't get psyoped.
It's so real, man.
That was just like the man. I know what you're talking about. That was just like the manager making sure everything was operating smoothly. It was the biggest job of her life, the most important people, and they just got to get the dumplings right.
I don't know.
That's what it is.
I don't know. I don't think I buy it, but I guess we'll see. So we're on the back of this entire thing. One of the things I was talking with James about before we came on to the stream was that there is a fundamental tail risk in the entire CapEx AI space right now. And it is that if Taiwan was invaded, the entire market functionally, especially the AI space, would have one of the largest bear markets and massive drawdowns that we have ever seen in history, because it is a linchpin for all of those changes. And everyone who is trading semis, who is trading software, who's trading the market, doesn't matter. All of us understand that risk very well. And if we see any risk like that, people are going, even if it's just marginal, people are going to slap on hedges so fast and going to get short so quick. And it is going to be incredibly fast. And again, people just don't get, which is one of the reasons why, if it happens over a weekend, and again, I don't know if it's going to happen or not. No one really does. It seems like a lot of people have really strong opinions that it can or can't happen, which just tells me that no one on either side is thinking about a redundancy plan. They're just kind of blindly holding to their, whatever school they went to and whatever school of thought they go to, because they've never been a risk taker. They've only been a strategist. When you think about that situation, if it happened and it happened over a weekend, where's the only place that it's going to get priced? Probably on Hyperliquid, which is why I actually think that the best play right now, and it's again, geopolitical risk and everything, continues to be Hyperliquid. And everyone knows that's my largest bet right now. And I think that it's going to continue to benefit. We already saw it benefit from the geopolitical shock when you had oil prices higher. It was one of the only assets in the world that rallied when equity sold off and crude began to bid. It was one of the only assets. And again, no one likes to talk about that. And the fact that they don't like to talk about that is an indication that they don't even have a position in it, right? If all of this goes back to what we talked about, that no one in this industry wants to talk about projects that are creating true value because they didn't get an early allocation or they didn't invest as a VC partner, right? There is no VC money or VC partners that got in on the ground floor in Hyperliquid because there was no VC money. And you can also tell that all of the big names, they have maybe a small allocation here or there. Look at some of the new changes that have taken place, but overall, not a ton. And when that takes place, what has happened, we really done this thesis, is over the last 4 years, people have only talked about crypto names because the developers gave them an allocation to the coins so that they were incentivized because they basically get paid to pump their own coin. But once you don't give them that, they're just like, well, why am I going to talk about this? It doesn't help me, right? And the absence of information about it is an indication about the lack of awareness in the value proposition that Hyperliquid provides. And so when you have all of these shifts, and if you have something over the weekend where everyone starts to get massively short the S&P and massively long the VIX, there's only going to be one place that people do that. And everyone on Wall Street already understands. I mean, a ton of people on Wall Street already recognize that they need to have a Hyperliquid allocation or a Hyperliquid account, even though right now it's still not legal from a regulatory perspective to trade it in the United States. And any trader, that is, especially in New York right now, they understand that, and maybe they're doing it on the side or not. Maybe they're doing it through a VPN, whatever it might be. I'm not saying that that's the right thing to do. It's actually technically illegal, but I guarantee you they're using it. And do you think someone who's going to say, oh, well, if we're going to have weekend news and I'm really good at trading and I can make a couple $1 million over the weekend, that they're not going to do that? Really? This just goes back to incentives. Incentives will drive regulation and policy. And that is what we're seeing on the Hyperliquid front, which again goes back to why my largest position continues to be PER, because it is the one way. We just saw, Goldman Sachs initiate a position, and people are more interested in getting long PER as opposed to Bitcoin, because Bitcoin has only showed that it is crushed by geopolitical risk, crushed by equity drawdowns, and that it's not benefiting in this current regime, especially as inflation risk is beginning to tick up marginally, which is why we're seeing people, especially last week. There was a day last week where someone bought 18 million shares of PER in a day. And that was this large update that we had. And that was one of the largest volume days that we've had thus far. And the option market on PER is going to be larger than it is on any ETF. And Coinbase or Robinhood are not going to have calls or puts on Hype, and they don't have them for anything else, or any other major crypto coins with any liquidity. So you're going to have, in the same way that MicroStrategy is the one-stop shop for liquidity to buy calls or puts, PER is going to be the same thing, which again is another reason why it's going to have an equity risk. It's going to have a premium above spot. It needs to. And it's going to continue to have that, which goes back to the entire thesis I've been laying out. But I want to circle back so we don't get distracted from the entire earnings this week. But I just think it's critical to understand how these moving parts connect, because none of these parts function in a silo. They are all connected. On the earnings side, you have NVIDIA right here. You want to watch if Jensen comes out with any news about developments with China, because if that comes out of the market, if there's any decrease in geopolitical risk with the greatest tail risk in the AI space, that is going to cause an immediate bid. Immediate. So that would be the thing that I'm watching, especially since we just came off of the entire move with everyone going to China and having meetings with Xi and everyone else. You actually have everyone in the same room, which is pretty rare. So you have these other AI plays this week. You're going to want to be watching those. On the software side, Intuit is going to be really key. Here's the thing: if Intuit gaps up on its earnings, I'm not going to say I'm a perma bull on Intuit or anything like that, but my suspicion is that we are already seeing dispersion and unwinds in the software space. I don't want to be short any software name right now. Just not interested. We've come down so much. We have this, kind of forming base right here. And it's a situation where, especially going into an earnings catalyst, it would not be hard for a short position to just get ripped and you kind of come up to these higher levels. On the Oracle trade, I would be watching Intuit earnings this week because Oracle is directly connected to the entire software sector. And if people begin to see that AI is not disrupting all these things as much as everyone thinks, and you actually have this edge in proprietary data beginning to get integrated and provide value and bring back a marginal moat, and the the distribution of outcomes narrow for software. Because remember, this chart that I originally shared on the software side right here, the software ETF has vol that's at 35. So we're almost at the same spot we were at in January. When this is so elevated, it basically means we could go up a massive amount or go down a massive amount, especially since it's remaining elevated as the price bids. It didn't collapse back down, which tells you that everyone is still pricing a very wide range for software because everyone is so uncertain about it on the upside and downside. And so as a result, any injection of certainty or clarity around a moat so that you can re-anchor expectations to price a multiple, that is going to cause a massive vol crush. And so even if we don't, move on to a new parabolic trend in software like we did in the 2010s or anything like that, if you have a vol crush as we move through some of these earnings catalysts, that could just be massive for a position unwind in Oracle. And any sector flows that are all net short all software, they have to pull all that back. So again, there's multiple factors here, and understanding that dispersion is just really key. Remember, a lot of positioning and wide ranges in software that are being priced by vol, and then a lot of net long in NVIDIA right here. And so all of those factors are kind of coming together for what we are seeing as we have this higher inflationary environment. And Workday is going to be really interesting as well because they're a cloud software for large enterprises running HR, payroll, employee records, and finance. And so they're one of the dominant names in the sector for a while. You probably know them if you've worked at any corporation. They're back down to their 2020 lows right now. Right, they're below them actually. And so would not be surprised to see, some type of short squeeze if they're going to decide to pivot. I think that right now, any software name, any software company, if they want to adapt, if they pull out an Elon type playbook where they lay off half their staff, pull in a bunch of, I mean, what did Elon do? There's the entire Twitter staff goes from like a bunch of, like granola white people to just a bunch of like Asian bros who are just like working nonstop for, extra Teslas on the side. And, if that happens, you could have a pretty significant rally right here in Workday. And, again, I don't think people are going to be that extreme, but if you see people say like, well, we have to do this or be disrupted. I mean, think about how much pressure the board has and shareholders have when you have the entire software sector getting disrupted. Everyone in the entire industry is talking about how AI is amazing. And then they look at you and they go, oh, you're one of the guys that's getting rugged right now, huh? Right? Like that's a lot of pressure to say, we gotta shift our entire strategy. And so I think that's going to be one of the things that you want to watch for, again, Workday earnings this week as well. On the housing complex, Home Depot and Lowe's, those are two names that are always really key to watch because when you have the entire housing market, I'll show you right here, get impacted by interest rates in the way that it is right now, where interest rates are rising a bit, and that's putting some downward pressure on people's ability to buy houses, then you want to look at the second and third order effects. So notice Home Depot right here moves in lockstep with home builders. Go ahead.
You want to change the
Thank you.
chart.
So notice here, home builders and Home Depot basically move in lockstep. Why is that? If you overlay the 30-year mortgage rate, when this moves up, let's see. Here we go. when the 30-year mortgage rate moves up, that begins to put downward pressure on these names because houses get less affordable and it begins to squeeze things a little bit. And so as you have these mortgage rates that have ticked up a bit, and you have home builders that have kind of come down a little bit, Home Depot, HD, in their earnings this week are going to give you a view into the housing market. And then also Lowe's is also going to do, something very similar. Home Depot and Lowe's move very much in lockstep. They kind of have a very similar business plan in play. It's like Home Depot, Lowe's, and then you have like Uber or Lyft, or you have, companies like Standard & Poor's and then Moody's, right? Like they're all kind of do the same thing and they're direct competitors and they're always just kind of trying to run their playbook. But those are names that are going to be important to watch this week as well, because if housing begins to see more pressure, that is very possible that it puts more pressure on what? One, consumer spending, and two, the administration, which is why if housing begins to get less affordable and you have more issues, right, with the consumer, which I don't think is going to happen on a broad basis, but that's going to send you a signal about these other names and why you want to watch consumer spending overall. When you look at Williams Sonoma, that is one of the names that did incredibly well during COVID, by the way. I mean, it just absolutely ripped them and Restoration Hardware. I just remember this trade during COVID, during the entire unlocks and everything. And now, we've kind of come back down. But in terms of the earnings this week, if we see any type of indication where they say, yeah, consumers are pulling back on some spending or they're now being really strong, again, another thing that's directly connected to the housing market. These are all the second and third order effects. These are all the second and third order effects of these changes overall. And so watching, where we're at right here is going to be, really critical as we move through this period of time. On the staples side or consumer staples side, we already talked about Walmart. You want to be watching them. We have earnings this week. Largest retailer, roughly 60% groceries. So again, if you're trying to think about food inflation, you probably want to watch the earnings for this week. 4,600 stores, U.S. stores. They have ton of changes that are taking place because they're trying to shift a little bit more, which is why their stock has been rallying so much. And then you have also off-brand stuff in terms of TJX companies and Ross. You can watch them as well. Other discretionary names, luxury names as well. On the industrial side, I want to cover these because, the world's largest agricultural equipment, Deere & Co., and also has a major construction equipment business, also a lender in precision agriculture. And then you also have Copart, online auction part for salvage and used vehicles, insurance companies. Again, these are both in the S&P 500. But DE especially, when we're in an environment where we're having all this AI CapEx spend, we have higher food prices, we have all of these, changes that are reverberating through the system. And you have, I think this is pretty interesting that we have, these kind of moving in lockstep. Actually, let me put DBA here. When agriculture prices are rising, I think it's just a very, very important thing to watch right here. To watch DE and their earnings this week and see if we can get any view into how exactly the macro picture for inflation is playing out. Because right now, the two biggest things that everyone wants to know is, number one, where exactly are the AI CapEx flows going to go as we have NVIDIA earnings? That's number one. And number two is how much inflation risk is in the system and how much is that going to impact interest rates? And if you've been following, we did multiple videos last week explaining how exactly the interest rate complex and the scenarios for them are going to play out. And one of the things that I laid out last week is we had a couple of different scenarios for why you could have the price go down, and you have a couple of different scenarios for why the price could go up. When we overlay those and stack those, we saw that my entire strategy that we went through all the signals for it is that at best you want to be neutral on bonds or bearish. And you're probably going to have a little bit of a tick up. And how much of a tick up? It all is going to depend on how much inflation feeds through from core or headline CPI. And if you look at how this is impacting everything, I'll actually go through a couple things right here on my dashboard. On the FX side, if you look at what is taking place on the FX model, and you see here is Euro USD, I'm sorry, the dollar against the euro, you can see here that 2-year real rate differentials have been the main thing driving the dollar against the euro. And so now the main driver that we are seeing why the dollar strengthened a little bit is because the US side is repricing just a little bit. And if you want a better breakdown of that and try to understand that a little bit more on the FX side, I'll be laying out a report later today on that. But on how high interest rates can go, this is going to be 100% dependent on how headline transmits into core. So notice right here, the headline version of CPI, it is ticked up pretty significantly. Month over month, we had a pretty big acceleration. And you have, these are the projections that we would have, where if you continue to have these same type of prints, which again, crude doesn't come down, those are going to be some issues. You're going to have a further acceleration in CPI. Everyone talked about it last week. With that being said, yes, we have some acceleration in CPI, but notice that core has not accelerated as much. We have, again, some tick up in where we're likely to go, and the risk is higher that it rises, but we're not seeing that transmit yet. If it begins to transmit and it begins to be a growth side of the situation, that's why we can have some more issues in long end interest rates, because that can cause inflation to reprice higher. And you'll notice that inflation swaps overall are sitting at these higher levels, and 1-year inflation swaps, 2-year inflation swaps are sitting at these highs right now, and they're waiting for the next stage of what the next inflation print and what it's going to look like. Longer end rates have begun to price in higher inflation expectations, and it transmitting through that system a little bit. So if you begin to have those rates move up, that can cause short-term pullbacks in equities, which is what you want to sidestep a bit. So you want to say, okay, if you have these small movements up in rates where stocks are down, bonds are down, rates are ticking up a little bit, that on a short-term basis can cause the equity market to pull back just marginally. However, it's probably not going to be that significant since we have all of the AI side continuing to be the primary concentration. So when you look at the SPY versus RSP ratio, we're seeing a greater and greater concentration in the market that has moved up over time. We're down on the day right now, and the reason for that is because we're waiting, we're adjusting and waiting for NVIDIA earnings this week. But a lot of people have said, oh, well, the SPY is outperforming RSP. We're just seeing a greater and greater concentration. Yeah, at the end of the day, the main thing that is driving equity flows right now is the entire semi space. And this entire move right here is because of semiconductors primarily. And so we're going to have greater and greater concentration in the market, which is very characteristics of melt-ups. And you'll see shocks to this positioning as interest rates spike marginally. But the underlying impulse is incredibly strong, especially as we have Kevin Warsh come in. And he's going to try to, I think we have several months. We have the summer before we have Jackson Hole, where they can give, really, I think he has time to pull over other Fed members to his side and what trimmed inflation looks like and what these new metrics and framework that they have. And again, people are saying, oh, well, he's only one person on the board, one vote. He can't really do that much. I think that expectation is going to get a little shocked because, yes, he's just one person on a board, but I wouldn't underestimate how much coordination Kevin Warsh can have with Scott Bessent and how well they understand the entire industry. I wasn't sharing this, was I? on how the entire industry can move. So again, I was trying to lay out the RSP SPY ratio and how that functions right now. I think we're going to move higher as we have more concentration, and that will connect to the NVIDIA earnings this week. So I think going back to the Kevin Warsh thing, I think people are going to be surprised on what exactly happens. So those are a lot of the main ideas. I have another section, but before we go there and talk about how all this connects to the geopolitical risk, I want to go through kind of some questions. So James, why don't we go through those, talk about those, and kind of break down these factors as they connect to what people are thinking about in the chat.
Sure. Just going back to what we talked about earlier, shout out to Singularity here. He has watched every stream for the last month. He feels much more knowledgeable about how the system was working. So that's good to hear. That's what we've been kind of going for here. And we hope everybody else can do that. So for a question from Singularity, when does inflation risk start to negatively impact equities? When earnings start to deteriorate or something else? And I feel like that ties into kind of what you've been talking about.
Yep. So there's two basic things that you want to think about for this. Number one is the economic function. When does inflation begin to weigh on the consumer? So if inflation begins to cause you, just think about this intuitively. If gas prices rise so much and your incomes don't, then you have to take money away from other areas. You know, all the white women have to stop spending money at Williams-Sonoma because they're having to spend so much money on gas. Probably not an upper K problem, but you know, overall, like that's how the mechanism works. So the question is, how much is inflation impacting real wages? Because the more real wages are impacting the changes in the economy, the more you can actually have issues in the labor market. Now, overall, I'll kind of pull up a picture of this. Here's a breakdown of where we're at in real wages. Now, we just turned negative for real wages, and we don't have the same type of strength in the labor market that we had right here. This is one of the reasons why I'm not like super interested in getting super aggressively short bonds, because we just don't have the same mechanism that exists in 2021, where remember the labor market was way stronger in 2021. When you look at, let me pull up the NFP numbers during that time. I mean, we were, especially month over month and the 3-month rate of change right here. I need to expand this. I need to add a function to expand this. But especially right here on the year-over-year basis, we just had such a more aggressively strong labor market. Oh, I can do this again. Let's see. Right here in 2021, we were at year-over-year jobs added at 5%. Now, I mean, think about it. We have at basically neutral now on a year-over-year basis. On a month-over-month basis, it was, you know, a 3-month basis right here. You can see it. I know it's not super good. I'll share a chart of this afterward. But the 3-month rate of change, it was just the most positive it's been in just a long time. So that is an indication about how strong growth is. We're in an environment where it's not as strong. And when we think about real wages, when they come down here, that could impact them a little bit more, which is why, you know, that mechanism itself could be, to your point or the question, yes, that side could impact inflation. However, what we need to do is weigh that and say, okay, when would inflation begin to cause deterioration in the consumer? That's why we want to watch these earnings. We're not seeing that right now. We're still seeing a lot of resilience, and you would begin to see, you know, more shifts in the curve that would indicate that. That's number one. Number two is, when does the inflationary returns cause a greater impact on the market than the earnings from AI? Because one of the things that, this is a chart that I shared. Let me pull this up actually, because this will really frame the entire thing.
While you pull that up, I just wanted to say this question ties right into this question too. So I wanted to show it.
Perfect.
As the inflation goes up, when exactly does it pour over to more of a recession risk than needing to favor tightening or hiking?
Yep. So go.
Guys, while he's finding that, if you don't mind, just go to Twitter and reposting this. I know we've been a little bit better at asking for a little bit of a call to action, but it would really help us share this to more, get it to more people. I think it's going to matter more and more as we move forward here. And the goal here is to help people, understand the regime better, to where when these big moments come, the everyday person is going to be more prepared to take advantage of it, not only on the long side, but for the inevitable downside. So if you could just share it and like it or comment or something, that'd be awesome.
Okay, I know this is taking a moment, but this is really going to be worth it, because it'll really show how you want to quantify this. Here is a chart of the semiconductor sector. And what you will notice is that during 2022, we had a marginal rise in earnings because we were beginning to see some of those changes, but it wasn't that significant. And that's why during 2022, you had this move over and semis moved in lockstep, but earnings moved up. So these are just earnings expectations. Now we're in a point where earnings expectations have moved up in a massive way to provide a higher valuation or a lower valuation. So I'll build another chart so you can actually see how this takes place and why it is the way that it is. Let's go to this. All right. Here we go. Notice how I have three things on the chart here just to help you contextualize everything. And again, you can get this chart. I'll lay it out afterward on the website, and you can just download this and go through it yourself. This is the 10-year interest rate. As it moves up, this is what we're talking about the inflation risk side. Now, the other thing that you have here is credit spreads in yellow. So you can see that when you had interest rates move up in 2022, you had credit spreads rise as well, because that inflationary risk was causing equity risk. It was causing functionally a repricing of duration, even though we didn't have a recession, which again shows that just because interest rates are going up doesn't mean you're going to have a recession. 2022 was a great example of that. Just because you have the curve invert doesn't mean you're going to have a recession. All these basic kind of axioms that people try to use that just, again, are not used by risk takers in the market. When you look at what happened here, notice that here in yellow, you had this rise in credit spreads. And basically think about it like this. When you have a pullback in the S&P, people say like, oh, that's a good spot to buy because I can get a higher yield. Just think about, or a higher, return on investment if I buy a dip versus a rip, right? That's what a lot of people are thinking. Notice that you had this move up in the yield. This is the yield right here in white. This is the yield of the semiconductor sector in the S&P 500. So if you would have, and again, there's some things that you go into this for the capital pricing and things like that, but because these are primarily earnings yields as opposed to like a dividend or something like that. But the yield went up here. But now we've come back down. However, it's still pretty elevated, which means that there's still an attractive valuation to buy the semiconductors with from the earnings expectation side. Whereas the rest of the market, we've come back down in credit spreads and we're back down at these lows. But as you've had this shift in earnings expectations where it's risen so dramatically over the last several weeks and month, that now makes the entire sector more attractive. And so if you're saying, well, when does this going to begin to impact when is inflation going to impact that? It's when the earnings are not growing as fast and you begin to have them, people say like, I'd rather put money in 30-year bonds than put them into semiconductor stocks. Once that takes place, then people are going to rotate out. Right now, on the valuation basis, we are not there. And so that's one of the reasons why, even though interest rates are rising, I'm saying, hey, listen, there could be some risk. You could have some pullbacks in equities or something like that. And we also have some positioning risk in NVIDIA, which goes back to this entire chart that I'm drawing attention to. Like, listen, there are risks out there. However, when you look at where we're at with liquidity in the cycle, where we're at with the equity market, where we're at with growth, there are some things that you might want to sidestep and be aware of. However, the broader picture continues to sustain the environment of an equity cycle melt up and a credit cycle melt up where equities make new highs. Could that shift if the data begins to change? Yes, but we're not there. And right now, all of the factors are continuing to point to the upside. With this type of market as well, and we'll get back to this question, other questions. With this type of market as well, you have to recognize there's so many idiosyncratic changes taking place that you just have to be so aware of how these things are changing and how to place your bets, because there is going to be a moment where everyone is going to get super one-sided and you're going to have an unwind that pulls the equity market down really significantly. It's going to come. Like, don't try to think that it's never going to be in the future or anything like that. I mean, it's just wishful thinking. There is going to be probably a position unwind sometime this year. And once the larger macro risks begin to materialize that I've been talking about, that this type of liquidity in the system doesn't last forever. Once that materializes, there is going to be a bear market. Right? It's going to happen. And the entire question is not about, okay, well, I just need to leave the market and get out. We've already talked about how that's not even an option, right? In today's market with where inflation is, that has a trade-off in itself. You can lose money in real terms by holding cash. There's a reason why Buffett and Berkshire Hathaway is underperforming right now. And again, sure, are they going to go up over time? Yeah, cool. That's not the question. The question is, why is there underperformance in some areas? How do we connect that to a strategy? And what are the moving parts that we need to understand to make an informed decision?
Next question here. There's a couple questions on metals. So how do you think about the relationship between the equity market and metals here? Now I know you've touched base on gold and silver a little bit, but moving forward here, any outperformance thoughts, things like that?
My view, let me pull these up. We have had the dollar. I mean, we've had Euro USD pull back a little bit right here, which is one of the reasons why we've had metals tick down over the last couple of days. But my view is that as you have these equity differentials begin to drive the market, and let me pull up, hang on one second. I'm trying to refresh this chart so I have the most up-to-date data so everyone can see it. So when we look at the dollar, right now metals are a derivative of two things. One, the dollar, and two, equity beta. That's what's driving metals right now. And when we look at the real interest rates, especially 2-year real interest rates, we are seeing that they're one of the reasons why that, the aggressiveness of the move up in real rates for 2-year real rates, and then also especially 10-year real rates. Right now, the long end is driving some of these changes in the curve. And so 10-year real rate differentials and 10-year nominal rate differentials between the US and Europe are one of the major things driving everything. So in this chart right here, you can just see here's Euro US, or sorry, the dollar against the euro. I just put it simply so you can kind of understand that. It typically is, a lot of times it's moving in with real rates. You just have to know how to price real rates. So the long end real rates, you can see that they have been leading the way. US real rates have risen more than European real rates. And that is true across, Euribor swaps and Germany and France and Italy and things like that, specifically on the long end. And on the short end, it's happened marginally too, because Europe priced all these cuts faster than the US. I'm sorry, all these hikes faster than the US. There is going to be a point where, this is why watching these equity differentials right now are so important, because, the fact that Europe priced those hikes faster, that's why the DAX is up on the day and Euro stocks are up on the day and the S&P is down. Why? Because basically Europe priced all the hikes and all the bad news faster than the US. And it's just like, okay, inflation risk is horrible in the Eurozone because they're short oil. And so they price all that faster. And now the US kind of lagged behind a little bit, and now they're pricing that a little bit. And now after that aggressiveness is priced in the United States, I think it's going to revert and begin to push the dollar back down, metals back up. And, the fact that we have I think Euro stocks are bottoming here. I think they're going to go and make a new high soon, especially the DAX and Euro stocks, and especially the FTSE. I mean, the FTSE, it's just so primed for a further melt up. All of these European stocks, because these people are not going to be able to. They're not going to be able to weather pushing against the Fed over the next 6 months. They're not going to be able to handle pushing against Warsh. It's just not going to work for them. And so this goes back to the entire idea. Every single economy in the world right now has a choice: hike aggressively and push their economies into a recession because the labor market's not as strong, and then China hollows out more of your industrial base. Or you can blow up the bubble further. And what are policymakers going to do? You think policymakers are going to choose short-term pain for long-term gain? It's not going to happen, right? Like they're always going to choose, let's just blow up the bubble further because that's going to keep us safe for now. And that's what the situation that we're in.
So a little bit more to tie into metals. Any thoughts on how the silver or copper is now considered part of that AI trade by many?
I definitely think copper is, and silver as well on a marginal basis. What I would say though is, like, broadly speaking, I don't have enough of a edge on the entire rare earth side. I've been looking into them a little bit more, but the rare earth metals, or all the metals connected to the AI trade, seem like they seem to, I think on a commodity basis, if they're just going to do really well, that makes sense. I think that we're moving into a stage, especially in the next 6 months, where there's going to be a lot more non-obvious trades, right? Like copper, metal, all these secondary effects, like shorting software, getting long rare earths, getting long, uranium and all this stuff, right? Like it's worked incredibly well as a trade. I don't think it's going to move, revert back down to the levels we were at in 2025, but I think there is going to be another non-obvious trade that people are not talking about right now that I'm more interested in finding than saying like, oh, well, AI, oh, build out, oh, CapEx, oh, metals. It's like, that's so well documented right now that I'm looking for something with more of an edge, if that makes sense.
Yeah, I mean, I think everybody thinks they're a genius right now, tracking down the AI 5-layer cake, right, to where they're getting to some stock that looks blown out that they think is going to rip. And let's just say I don't really feel like investing is that easy. Now, this previous move, I feel like, was that easy if you had kind of been thinking about that before everybody had a chance to really understand it. But once this epic AI thrust has occurred, that pushes everybody down that road. And I agree. I think, and we'll talk about this a little bit more on the narrative arc thing, is like, I think you got to be looking at the places that still make sense with the story, but aren't where everybody's head is going. So, anyways, I think that's a good question. Let's dive a little bit into the Japanese side of things. You can see that the Japanese 10-year and 30-year, I think, were making close to highs today. And they were just a couple questions on how is the Japanese side of liquidity being monitored. It was mentioned that it was a big factor and still coming into play. And then this one as well, why are the U.S. and Japanese bond yields up so much simultaneously? And you're muted.
Awesome, thanks. So very simply put, I've been laying out for a while now that the yen is likely to move lower. That has been my base case. We've had these little spikes. Every single time we have a spike, I get a message about it. And, again, to be clear, these are decent, reasonable spikes to ask questions about. However, this entire move that we have had in the yen has been systematically pushing capital out the risk curve. And I think the yen is going to move lower until not the BOJ intervenes, but one of two things happen. One, we start seeing an unwind in the equity market in the Nikkei, or two, you begin to have a decrease in government spending. So this goes back to the entire idea of like what has driven Japanese markets. And my view is that the Japanese side is still putting positive liquidity into the United States. Why? Because you have government spending happening in Japan that is the largest it's ever been. I don't know, maybe not in history. I'd have to double check that. There was a lot more indirect government spending, so we'd have to it's less about the outright data and how much and about how we calculate it or define it. But we're seeing record numbers of government spending. So just think about right now, Japan is like 2021 vibes. Ton of money going into the system. The BOJ isn't being restrictive. Long end rates are pricing the difference, but short end government spending is increasing more than long end rates are being restrictive. And you have to remember too, is if you look at, this will go back to Japan. Let's see if we can look at the dollar versus the yen. Here's the dollar versus the yen. And we'll go to just nominal rate differentials right here. Let's go, here we go. Notice that we've seen nominal rate differentials move in lockstep basically this entire time. The entire play, especially for 10-year nominal rates and 2-year nominal rates and the actions of the BOJ have been a nominal rate differential play. What is beginning to occur is that this gap has formed. And what you need to ask is, like, why is this gap formed where the dollar has rallied, the yen has gotten devalued, and the rate differential has diverged? The primary reason that this gap has occurred is because government spending in Japan has increased, and they're primarily funding that with bills, which if you look at all the news announcements that have pushed the yen cross around against all major currencies, what's the primary factor? Is it nominal rate differentials with the BOJ? No. It has been announcements of issuance by the Ministry of Finance, which means that if the Ministry of Finance comes out and says, hey, we're going to spend a ton of money that's way above expectations, and then you say, okay, well, how are you going to fund that? How are you going to pay for all that stuff? And you're going to say, are you going to issue bonds or bills? And they say, we're going to issue all bills. Just think about what that means. You're injecting into the system a government liability that the government is not going to default on because they're just going to adjust their currency. And it's primarily 3 months, 6 months, a year in duration, which means it's almost money-like. It doesn't carry any duration risk in it. Whereas if it was a 30-year, then it might carry some more duration risk, and then maybe it'll pull down the equity market a little bit more. So when that happens, the currency has to price the differential. So that's the environment we're in with the yen. Now, On top of all of that, add in the fact that crude prices are ripping. And when you have crude prices rallying, that impacts Japan because they are net short energy. They're net importer of energy, which is why this will go back to, let me find the chart really fast. When you look at Japanese inflation swaps and you go through that data itself, it begins to tell you the picture that inflation risk is increasing in Japan. So here's inflation swaps in Japan: 1 year, 2 year, 5 year, 10 year. Notice that the curve is really steepening more in Japan right now. The longer ends are beginning to rise and make new highs. 2 years still kind of at these lower levels, and we're waiting. But this is going to create a massive issue because remember, they're trying to manage. The only reason that Japan as a country hasn't collapsed is because over the last 40 years, they've owned so many US treasuries that's hedged their currency functionally. And so now they're shifting that entire thing. My view is that once this entire melt up stops and the global carry trade unwinds, similar to what Paul Tudor Jones said, you'll have an unwind and you'll have the yen strengthen. And it'll be one of the most epic trades you'll have in history. Until that time, a lower yen is directly connected to the credit cycle, and interest rates on the long end specifically are still not restrictive enough. And you'll notice right here, notice that in real interest rates in Japan, 1 year, 2 year, 5 year real interest rates are all negative right now. So again, that shows you that the Bank of Japan is not being restrictive into this inflationary impulse. So you have the BOJ, even though they're holding rates a little bit higher and they've hiked a couple times over the last couple of years, whatever. Real rates are still negative on a 2-year basis. And that is what frames everything that's taking place right now in Japan.
It's really amazing as an example, right? Because everybody on, let's just say, FinTwit, right, posts about the 10-year and the 30-year in Japan just ripping to the upside. But this is the actual psyop we've basically been talking about, because you just explained it like, well, if that's the case and those are going up, like their primary defensive mechanism right now is issuing a ton at the short end, which is almost money like, which is just going to like effectively debase their currency even more and push everybody into equities until something like breaks off the back of that, or like, and then you got their shorter end real yields in negative territory, and not like even, they're not even like hooking to the upside, they're still like heading downward. So that just adds fuel to the fire of pushing everything into like one place, right? Could you overlay the Nikkei on or just pull up the Nikkei on your chart, just so we could see what's going on as the 10 and 30 year rip to the upside? You probably have to switch to the chart if you're doing it as well. Yeah, and you're muted. I don't know if you're saying anything, but there, I mean, like that's just a great example of what's possible here, and I think you're even explaining how it could happen in Europe too. When like you've been talking, it's like ironic, right? You're talking about the hollowing out of Germany and their industrial base and like how everything's fucked up over there. Yet, ironically, their equities could rip to the heavens with higher long end rates, right? Which is like exactly what we could see here as well. And I just feel like everybody is so focused on like long end go up, bad, recession, equities fall apart. And I feel like everything you're talking about and laying out here is almost the opposite of that, at least for before the reckoning.
Yeah, exactly. I think we're supposed to have correlations confuse people. That's part of the progression. So if you're seeing that happen and people are just kind of ignoring it and they're like, well, I don't know, like let's just maybe we'll just focus on moving averages today. You know, it's always the that kind of like focus. That is a telltale sign that you're in a regime where extreme things are going to happen, because things are most understood in their underlying mechanics. And I've had people for a long time, especially in Japan, they're in the United States and they go to Japan, they say, oh, well, look, yields are just going through the roof. That has to be bad. I'm just like, oh, great. There's, you probably don't understand a ton about Japan and how their balance sheet works. Very different than the United States, actually, So I think all of these things are really good because, most narratives you see out there are what? Well, Japan is only about the carry trade. Is it? It's definitely connected to it, but is that the only thing that's taking place there? No. There's actually, I'm hoping maybe he's watching. I'm hoping to have him on stream sometime soon where my buddy we can talk about all the things that are happening in Japan in terms of like all the culture stuff and playing cards and other stuff, because I think that's actually something that no one's talking about. And most people underestimate, because I still don't understand the obsession or the underestimation where if people talk about some type of new thing that's taking place or that money's going into, they just immediately have like a boomer impulse and they're just like, oh, these dumb kids are betting on this stuff again. And I'm just like, well, I doubt Stanley Druckenmiller would ever have that type of repulse. He would see a young kid doing something and be like, oh, you know what? Let me talk to you about that. Tell me more about that. Right? Like, explain that to me. Right. And I think that's when these guys talk about, oh, I like having young people around so they can kind of bring stuff up and talk to me about them and this and that and that and this. And how, Druckenmiller was like, oh, yeah, we remember, years before NVIDIA and years before all this stuff, all the kind of smart kids I was talking to were talking about AI. And that was like, what, 2020, 2021, 2022? And it just goes to show you that everyone is, so closed-minded that they push off some of the biggest opportunities that they can have.
But think about that, right? Like if they don't look past that top level story, and we have a pullback in equities and a positioning shakeout, but in reality, it's setting up for a long end rate melt up, a devaluation of the currency, and a drive into equities. Think of how much more valuable positioning into some of those positioning unwinds will make your outperformance for the year, right? Because if it goes down, these guys are just going to say, oh, here we go. It's the start of the bear market. And those guys are going to be the ones that get ripped out and washed out as you climb that wall of worry moving forward. So, the like second order effects of understanding it at a little bit of a better level is going to add 10, 20, 50, 100% onto your, potential yearly returns.
I totally agree. And I think this all connects to understanding how we're seeing a convergence in the geopolitical environment and the macro environment. And when you look at how that's shifting, I think you're seeing this convergence around tails. And this was one of the things that I pulled up for us to cover, is this entire idea of TSMC and how this in itself is impacting the United States, because it is a tail event. It's showing how all these geopolitical events are impacting macro now. So think about TSMC. They've made a $165 billion commitment in March of 2025 for 11 fabs to be built. And this is causing foreign direct investment. It's changing things. And you have all the bleeding kind of edge of chips are made in Taiwan right now. And Arizona first, you have a lot more fabs getting shipped, but they're basically a generation behind. And so this is one of the largest kind of factors that's beginning to move the underlying shifts in things. And I think it's misunderstood, because when you have these underlying events happen, and I have a breakdown here of how much dependent is there on where the chips come from of today versus 2030. And then you have this crucial question: isn't the US building fabs? Yes, obviously. The question is, how much of total capacity is actually shifting? And here's a breakdown. For 2024 and 2025, we had 92% in Taiwan, 2027, which Arizona, they're ramping up for that, and you have by 2027 you'll have 10% in the United States, and then by 2030 you'll have 22%. That's still a pretty significant risk. Now, just think about go under the surface for this a little bit, and I have an entire breakdown. If you want this deck afterward, I'll send it out. It'll be 100% free. You can go through all of this. You can go through how to think about the different factors. The is this hollowing out? Is this an insurance policy? How is this impacting China? You can go through all of this. How is this impacting each major company? Apple, Nvidia, AMD, all these different winners, losers. You can go through all of these and how it progresses with catalysts and the CHIP Act and everything. All that's right here, and you can go through that on your own. I'm going to walk through probably more of it tomorrow in the stream that we have. But just this in itself, I just want to cover this idea. Think about how much Jensen, Trump, every single major tech guy who is in China is thinking about this exact idea. Think about even how much this is playing into Trump's decision to go and have geopolitical unrest and initiate more things in the Middle East. And he's saying, well, we need to control a little bit more oil so that we have control over oil a little bit, and we pull China's dependence back a little bit so that when we go to China and we have a conversation, we have a little bit more leverage and discussion power around X, Y, and Z. I mean, no one wants to talk about that stuff because no one likes Trump, right? And there's just, once there's an individual connected to something, there's this blinding effect that happens. And I guarantee you that every single major backroom conversation is all about how these specific factors, especially around chips and the AI arms race and everything like that, how is that reverberating through every discussion that takes place? And I think that connects to a lot of the things you've laid out about how do you look at where we're at in this progression? How do you look across the table and say, what is that person thinking about this information, instead of me just thinking, does this information push my single equity higher or lower? I don't care about anything else. I only care about this one thing. Higher price or lower price. And you're like, okay, I think that's an important conclusion to come to eventually. But if you're going to have that narrow of a mindset on the front end, you'll never see the opportunity on the back end.
Also, it goes back to that age-old poll of like a bunch of guys, and they were like, do you think you're above average? And like 98% of guys said, absolutely I am. And you're saying you're pretty much all sitting there in your desk chair in your home thinking you're better than 98% of capital allocators in the hardest game in the world. So it's always good to just maybe sit back and reflect on that a little bit. Yeah. Well, just a couple last quick questions that you could wrap it at these, and then we'll move on. You said NVIDIA is great. I guess. Are you thinking the same for Tesla? It doesn't seem priced in yet like NVIDIA, or does it?
Here's what I'd say. Short term, Tesla is all about how we're trading through the SpaceX IPO. And I would be watching Tesla relative to the SpaceX IPO market on Hyperliquid that just got launched last night or yesterday or in the last 48 hours. That's one of the key things I think to be watching. And if you're watching that, you'll probably get a better view of Tesla, because I think people want to be Elon neutral, and you're going to have a lot more pods be trading long short between Tesla and SpaceX that people realize. So I think that's one. I think that on the Tesla side, I think there is a lot of upside. A lot of it depends on, I think, how we have all these different moving parts merge. I think overall what I would say is that I think there's still a lot of upside in Tesla over the next couple of years. And I think that it'll all depend on how much self-driving retools how consumption functions, because I think it could become a dependent function of the entire economy, right? Where people, I mean, there's already a trend going on where young people are like, why do I need a car? Wait, why do I need my license? I don't understand. And they're like, well, you have to be able to drive places and this and that. And you say, I don't understand. Why would I need to do that? It's it's kind of funny. I was talking to our friend, and he was like, oh yeah, we got one of the kids self-driving one of the Teslas, and I was like, why? And I was like, wow, she keeps hitting things, and I was like, well, shouldn't she learn how to drive better or whatever? And it's just like, no, like let's just get a self-driving car. I mean, she knows how to drive and everything. It was just like really funny. Of like, it's just like, there's like, this is not a good idea. Let's just get you guys on self-driving and let's just not think about it. I mean, just think, it's like it's gonna seem so obvious of like, I just don't want to have to think about like crashing, and like this just seems so easy, and now I can be on my phone more. So like, just leave me alone.
Telling you, once you do it, it makes a lot more sense. It's kind of like peptides and self-driving cars, man. Before I knew it, I'm in the future. It's crazy. Real quick, I'm a new subscriber to Flows. Welcome. Our only positions, Oracle and Per. Thank you. Great live streams.
Main positions right now, these are the two big bets that I'm taking: Oracle and Per. Per is my largest position, and I'm working on the next ones that I'm going to be taking. Those will be sent out to paid subscribers as they come out. And I'll share the entries for those. And after we have some progress on them, then maybe I'll share them for free subscribers, but only when we kind of have more progress. But my view right now is that those are the best asymmetric bets, and that we're moving into a period of time where I just think Per and Hyperliquid are just the best bet in the world right now. And there's a lot of other things that are melting up, and we're seeing the skew blow out with them, with NVIDIA and the semis and everything like that. And I think we have yet to have the big move in Per. I still think there's a lot of upside in Per right now, and in Oracle, like in a major way. Per specifically, I mean, again, we're not going to go over price targets and all of this other like whatever stuff. I think we have a lot of upside. That's what I'll say. So
on Per real quick, I would bring up that article that you wrote on Per, or a link to it. Ardor here, if you have a reservation about Per, I assume you don't know much about it, because if you think Hyperliquid is Per, it's not the same thing. But you could go read this article, and about Global Flows breaks down the idea of how Per can kind of cultivate that premium and create that edge and that centralization a narrative, and craft that as the leader in the space. And they could also not do that as well. So it's going to be ultimately your decision, but I would suggest going and reading that, because he breaks down probably a lot of what you're concerned about if you're looking at the people in the About Us section. Anything else you want to say on that, or is that
no? I think that's all pretty straightforward. Just go through all the research and you'll find it.
Okay, last thing here. Good question. Is there a chance for both software and hardware to catch a bid simultaneously, as opposed to being inverse of each other during this run?
Yeah, 100%. I think that's actually my base case. It's not going to be just inherently like a long short pair, like one has to go up and one has to go down. I don't really think about it that way. I think that we can have short-term moves that occur like that, but overall, I think they'll both eventually move up together, and that will be what causes one of the largest moves in the melt up, especially when Microsoft begins to actually bid. Because remember, Microsoft is pretty large stock in the index, and it's in the software sector. So watch Microsoft really closely, because when that bids, that's your signal.
Okay, so yeah, let's jump over. A lot of people right now are looking at all sorts of things, and I know a ton of people who are very much allocated heavily, right? Because and we'll talk a little bit about this, but like, we're in a new paradigm. This time is different. Look at the spending. It's going to, I mean, it's robotics. It's the hardware section. It's metals and chemicals and space, and all of these different narrative arcs that we all know about. And I just wanted to make a quick slide deck for you guys. And a lot of the stuff I talk about is for beginners, intermediates, people that need to learn expensive lessons. And I'm hopefully helping them think about them to save them a little time and money in the long run. And one of the things I think even I, after so long, get caught up in is getting positioned or investing or trading or whatever you want to call it at the wrong part of the narrative arc. And to me, you can just assume that, let's just take this whole AI movement and CapEx build out and whatever as an arc, right? You have this period of time where like not many people are talking about it. They barely know what AI is. They're just focused on the normal things. That was that stealth mode, right? That was way back in, when would you say this was when this whole thing started? Maybe NVIDIA's kind of blow up. When was that?
For AI?
Yeah.
I think it was honestly
when ChatGPT first came out, basically.
I think when ChatGPT came out, that was the beginning of everything.
Right. And that was kind of around this like awareness point, right? On this arc of this grandiose AI narrative. You could argue where we are now, but the point I'm trying to make is that when you think about the voice, the audible echo, where are we on that narrative? And everybody's going to think we're at different points, but there tends to be this, kind of constant stream where it starts at nobody really knows what's going on. It's cheap. Volatility hasn't expanded, whatever. Then you're going to have the smart money move in as things become more and more aware. Then you're going to have the retail phenomena run up into a euphoria and a mania, into a blow off. You're going to have excess returns here, absolute craze, portfolio allocation like crazy. One of our buddies just showed the 2x, 3x ETFs in the AI and semiconductor space and all that have had record flows recently. And then you're going to eventually have the backside of any narrative to where it's forgotten, all the people that thought it was a new paradigm or whatever, and you're going to move into this time of despair. And I think this is fairly straightforward, and I think all of you understand that intuitively. But my whole point here is that we're at a time where you're going to get swayed. You're going to get modernly propagandized, as I like to say, on FinTwit by your favorite follows. Just because you don't watch Fox News doesn't mean you're not being influenced by people with incentives and creating you as a product, creating you as a liquidity exit, right? So anytime you are getting into a position nowadays, start to think like, where are you on this narrative arc, right? Again, this is just like a different way of looking at it. The asymmetry is going to be a lot better if you're starting to think about things like Flo's just said. Like, I want to be looking at the things where the narrative and the thought is not being focused on. I could get into my Bitcoin thesis and my MSTR thesis and blah blah blah, but alas, are you noticing that you're tending to enter around these areas? Or are you starting to get over in this area where things are euphoric? It seems obvious. Volatility is expanded. Options are expensive. Well, if you are, arguably the asymmetry is dissolving at that point, right? And yes, I get it. Some of the best money is made in the later opportunities here, but it's just something you got to think about and be cognizant every time you feel that urge come up to go get into something. And I've talked about this on some of my videos, is I made a big blunder last year in the Bitcoin mining space when it was they were all transitioning into AI, data center, energy, whatever you want to deem them. And I got in more or less here. And I experienced a couple of weeks of upside and thought to myself, thank God I got in this thing. I knew it was the new way of things. Like they're Bitcoin, their energy, their AI, all into one, right? But I hadn't really thought about vol expansion, positioning, euphoria. All of the good news was being priced in. Contracts were being written by hyperscalers. All of that had already been like moving into the price. at a very fast and alarming rate. And then, of course, because I won a little bit too, as we rolled over, I kind of was thinking, it's okay. This is the way of the world now. This is actually a good opportunity for me to add. And I took one of my biggest loser. Well, no, it was my biggest loser in my career over the next like 4 or 5 months. And if you go look at like Iron or Cypher, any of those Bitcoin miners, wherever you see that previous low, probably earlier this year, that's pretty much where I exited most of my positions. So I got in at the worst time and I basically exited at the worst time in something that over time probably is still a good allocation of money. And I did it with improper leverage, yada, yada, yada. Yeah, that we'll leave it at that. So also, I don't know if you want to jump in here at all, Flows, but I'll keep going unless you had anything related to that.
Well, I think it's good. Why do you feel like when you kind of look back on that period of time, why do you feel like you were in that position to make that decision? And how do you kind of look back on it now and say like, oh, here's where that started, or here's kind of like the stepping stones where that started?
Yeah, honestly, and that's great. And we talked about that last time, right? That like the problem wasn't exactly me making that first trade into like Iron. The problem was me having a year that was just not up to my snuff, right? Feeling like I was behind, seeing everybody else crushing these things, and feeling like, man, this is my chance to get my year back, right? To feel like I'm back in the race. I had left futures trading like 5 or 6 months before that. My swing trading and quote unquote investing wasn't really doing anything, and I was kind of break even. So I was like, this is my opportunity to catch up, right? So I was blinded by a little bit of FOMO, comparison, all of the things that everybody deals with but doesn't really like to admit. And that's what drove me to not only bet on these things, but to bet large, because I just got so convinced that, and you get really good at making up stories, and that's kind of why I've taken a big step back. I'm trying to learn a lot more about how to think through things a bit more clearly before I absolutely ape into them. Because if I've learned anything over a long time, it's that like you always get another chance to enter things. It's not always a lockout trade forever. So does that kind of make sense?
Totally.
Yeah.
So I think it's so good, because I think it's again, I don't care how long, it's like Druckenmiller being like, oh yeah, I bought stocks at the high. I shouldn't have done that, and I lost $200 million. Right? It's like, he had a lot of experience when he was doing that at the time. He was managing a lot of money, and I think that's not beyond any of us to be a really good, it's like a good person making a bad decision, right? Or someone who's really competent at something, just, getting in a situation where they still have to take accountability. It's still their fault, but it doesn't mean you're not susceptible to that. And I do think that there is a little bit of culture around not talking about that, because it gets so easily clipped, twisted, psyoped into like 100 different ways, right? And I think that there is so much more of that exists that people would like to acknowledge in the world, and then even in their own life, because I think that's all real for me and for you and for everyone.
Yeah, and especially here, especially if you have a little bit of a following, you just don't want to look stupid. And you have this defense mechanism against doing that. But I think the more raw you can get, the more silver linings you can find, the more okay you are with admitting that you just don't know everything and that you're going to make mistakes, the faster you can learn from them and the better a trader you'll be down the road. That's, I think, another reason of staying in the seat. Stan Druckenmiller could say, I had imposter syndrome for 15 years. That's something only Stan Druckenmiller is going to say. You're not going to catch a 24-year-old crypto bro saying like, yeah, I don't know anything. I'm just trying to learn. Like, I'm constantly making error. It just doesn't happen as much. And I implore you to try to think about that. So, by the way, on these arcs, you're going to have mini arcs, right? And think about whether or not you're a momentum trader, a mean reversion trader, or whatever. You could get caught in really big debacles at any of these points, right? You could have the breakout at the first spot. You get rushed in there. You think this is it. It's happening. The thing I've been waiting for, lever up and get absolutely washed out before the real move happens. And if you're a momentum trader, you got to start to think about like, where are your, more genuine entries going to be? Where could you add to your winners to reward the capital that's rewarding you? Or if you're a fader, right? If you're somebody who's more like a mean reverter, how could you, whether or not you're bullish or biased, you could start to, kind of aim for these points. When does Euphoria get on sides? You could say Leotard or whatever, he's put on a ton of, he's the AI guy. He's the AI whisperer, the AGI phenom. And he is putting on massive put positions, whether or not that's hedging or it's some of it's outright or whatever. Clearly, he's able to at least think about these arcs within the arcs and maybe try to protect some of his capital, even though in general, he's been on the money for everything that's going on. And here you go, the narrative trap, right? These are all the things that, we're seeing a lot of this right now. Can only go up. Don't fight the trend. This time is different. It's a new paradigm. Everybody's making money. Hey, hint, they're not. This is going to be pricing in for years. This is the only place to be right now. Why would you ever be in crypto? Why would you be in bonds? Why would, blah, blah, blah. Just beware. This is like anything else. So that doesn't mean don't invest in this stuff, but your positioning is going to matter more and more as these speed wobbles get crazier and crazier, and the rotations and the volatility being expressed whipsaws back and forth between there's all these sectors. It's not like it's just one sector anymore.
Yeah, James, can I add one thing there that I'd love for you to expand on is, even if someone isn't trying to sell you something, right? Even if someone isn't trying to sell you something, so many times people just want you to believe and understand what they're saying just so that they feel better about themselves, right? And I think one of the things that I always come away with is, you should always make sure that you help someone put pressure on themselves in the way that is best for them, right? You should not put pressure on them and say like, hey, you need to do this thing because I'm doing it, or I'm doing this thing and I'm trying to get you to do it, or something like that, just so that if we lose together, or something like that. It's so arbitrary and not wise. And you should always be asking like why someone's doing that. And is someone putting pressure on you to make a decision that's just prescriptive or arbitrary? Or are they putting pressure on you to say like, hey man, like, how are you being disciplined? You figure out what that looks like, right? Are people pushing you toward fundamental principles or toward prescriptions of like, oh, you have to do this one thing, you have to do this other thing, right? And that is just so critical, because people might not, unknowingly, well, probably knowingly, but they don't have your best interests at heart, right? Even if they're trying to help you make money, right? It might not be the right thing for you.
Yeah, and they want to, you're very focused on kind of seeking truth, right? And if people aren't focused on seeking truth, they're going to kind of crowdsource their subconscious. Yes, they're going to want to bring you in so that, hey, if this doesn't work out, at least I'm taking somebody else down with me. And if it works out, I'm a hero, And I think that's one of the reasons I've always liked the networking idea and building a core of people around you that are willing to seek truth, is that, I could tell you an idea and you do it in a way that's great. And this is how everybody should try to kind of aim to do this, is you'll be, instead of saying like, that's a fucking dumb idea, dude, not truth in that way. You'll see like, oh, I kind of see what you're thinking. Here's a few other points that might help you think about that a bit differently. And maybe it changes your mind, maybe it doesn't. Right. And that's a much better way, I think, of approaching it, especially if you're looking for a long-term relationships with people in the investing community, because you're going to have ideas where people don't agree with you. You're going to have some that they do. And you always want to be cultivating that open. You don't want people to be scared to come to you with an idea, and you don't want to be scared to approach somebody else with an idea thinking you're just going to get slammed, or else you just will never do it. Right.
Right. Yeah. 100%. I think it's good.
So beware of your friends. Beware of their intentions. So where are you positioned? So again, these are just some I like this. The nervous system is part of your data, right? Feeling inside of you, boredom, frustration, doubting everything. That could often mean you're getting into a position that is early, and it's going to feel gross, right? And certainty, just when you feel like this is absolutely where my money needs to be. If that's where you're entering trades, I would just say, be warned, right? Just that's an interesting way to think about it. Is what are you feeling initially about your entries and even your exits? So let's talk about PER a little bit, right? Can you bring up also the PER chart, just the background? You can flip over to it, but I think you're seeing right now, right here, is what's happening in PER, because early on, what did everybody say about treasury companies? Absolutely hated. Did anybody know about PER? Nope. I mean, you were mentioning the Twitter mentions, right? The impact of PER. It's like there were like 10 mentions every other day or something at best.
Yeah, and
right?
8 of them were me.
8 of them were you, right? Maybe all 10. And what were you doing? You were accumulating. Nobody was even considering, investing in these things, and they just didn't look at it. This is when you were positioning $3.30. When it arced over, hey, going back to that mini arc, right? Like, let's draw a little bit here. Like we had that first kind of mini arc, right? Before it kept going, which is kind of the chart we're seeing. And you added, so you were accumulating here and you added big here when absolutely nobody in their right mind would have added, right? Other than maybe the hyperliquid enjoyers who already owned hype in the first place. And now I would say we're somewhere in this kind of interesting area, awareness area, right? We haven't had some crazy hyperliquid mania blow off, whatever, but we're somewhere around here. And if you want to switch over to the PER chart, we could kind of see that in real time, right? This is kind of it. You had that first run up from 330 down up to, what was it, like $4 or something maybe, and then it dipped out again. And you added more, and we've just seesawed back and forth, over and over. But the whole point of global flows here is like we want to get into a position in that accumulation stealthy area with asymmetric upside, and we want to get on sides, right? Because if we could do that, we could better think through the noise, through this whole process, and hopefully start aiming our goals and our eyeballs on an exit, a graceful exit that we know we're probably going to botch a little bit, but that's okay, because we're going to botch the entry a little bit, we're going to botch the exit a little bit, but how much can we take advantage of in the middle there? I think so far it's been cool. And by the way, if you were a Capital Flows paying subscriber, you were also, if you were on board with this whole thesis, and if you were, taking out a risk, you were accumulating down here. And we're working our way this way. And then, hey, we'll take a look back at this and see what happens if we eventually hit there, right? And what we're trying to avoid in the end is this backside where, your identity gets attached to the trade, where you don't want to see the drawdowns from the peak, et cetera, et cetera. Now, what's the other one? Oracle. All right, let me get rid of that. Sorry. We've talked about this. You could go watch Global Flows' videos on Oracle about Larry Ellison. The articles, they're all there on capitalflowsresearch.com if you haven't seen it. But the trigger to all of this was Larry Ellison taking a very, very big bet, not only spending all of the cash flow, but going into even more debt to really take a swing at this whole AI play. And because of that, as we looked before at the flows of, maybe you could bring up in the background the sector flows of Oracle, and we could see the fundamental, the sector, the indexes all causing this massive unwind in Oracle. So the market was pricing it not only fundamentally, but through the sector, through the index, through positioning, through sentiment, everything. Yeah, go ahead and throw that up. And you can see all of those things just kind of dumping to the downside here. Oracle goes down roughly 60%. And you started crafting this thesis around the turn. Honestly, pretty close to the lows here. And we, again, are kind of climbing out of that despair, and we're back in stealth mode. And I would say only recently has anybody even started mentioning Oracle again. But we're already positioned. We're already on sides. It's the same thing in a different form. We have the asymmetry now. We have the time on our side, and we have a clear mind. So this all goes back to finding where you are on the arc and trying to position yourself into stuff where the mini arcs and the bigger arcs and the bigger arcs all align into a spot where you're going to find what you're looking for in asymmetry.
And I think one of the things is aligning those arcs is how you get on sides, right? Like when you have those different arcs, if you overlap them, that's why people can get like a massive trade on sides and not risk a ton of money, because they like overlay these arcs and they're like, oh, I just stacked one arc on one time frame and then another and then another and then another. And then you're like, wait, how did you get such a big position on and you didn't like lose a ton of money or risk losing a ton of money? And you're like, well, I just tried to keep getting on sides. And I think that's the key to everything, is like just trying to get on sides and always protect your principal, which is still a concept that eludes most.
I totally agree. And it's hard to do it, and it's hard to add to winners. That's only a concept I've really even thought about in the last couple of years, like a decade later, and this goes back to understanding interest rates and the price of money, right? Because if you could understand the foundations here, it's going to allow you to look at these moments with a lot more clear vision and to be able to pull that trigger when it feels its worst, so that people are messaging you, here and here, and wondering how the fuck that happened. Right? And that's literally what we're trying to do here, is like, to get in at the extremes and to find this massive win that a lot of people aren't really able to comprehend how it even happens. So yeah, good addition. Aligning those arcs is exactly what you want. So we're almost finished here. Sorry, guys. The self-awareness, like the more you could dial in your self-awareness and the understanding of these arcs and where you're at in those narratives, the more you can make like an easy decision. You can start to kind of dial in, well, okay, if we're at the stealth mode of this big arc, what's my time horizon? Well, it's going to lean more towards long, right? But if we're in this like mania phase up here, we're going to start to calibrate this and be like, okay, I'm aware that I'm a little bit late. I understand the vol metrics are going up and the speed wobbles are going to be big. So I need to shorten my time horizon a bit, right? I need to maybe size down. I'm probably going to be more reactive to the things out there and the FinTwit propaganda. So, right, like this is the opposite of down here, where you're going to be longer term. Maybe you can put on a larger bet and you're going to have a lot more clarity because you're going to get on sides, right? And that's what we want. We're going to get on sides so that we can wade through the waters as best as we can. And that just takes me to the last part here, which is exactly that. This is more the early phase, right? Longer time horizon, larger size, adding on weakness, holding throughout the doubt, right? That's what we've been focused on for the last couple of trades here, or whatever you want to call these, swings, investments, right? And then if we're in this late phase, which you could argue for some things, you could argue whether or not we're in a late phase, start thinking about shorter time horizon, maybe adjusting your size, maybe scaling out, even though the price could go up, with tighter stops. And if you could do this and bounce back and forth between these and adapt, you're going to end up being a great trader, a great investor, and you're going to do big things. So hopefully that helps you guys at least think about some of your next moves out there in the markets.
I like it. I think all of these different ideas, I mean, even the thing of, that's something so simple of, hey, when we're in a late phase, you begin to adjust. Oh, we could go up way more. Or, and people are going to try to like time the top perfectly instead of just focusing their mind on, let me just keep it developing information, developing edge. And, I think we're moving into a late stage. Maybe I'll just tighten my stops, buy a little bit of calls, and reduce my position size. And now you can spend more time thinking about the signals and not get really unhinged because your position is too large and you feel that, things are just getting a lot more unhinged. And can you just avoid all that by having a systematic strategy that just buys and sells and you don't ever think about it? Yeah, sure. You can also have the returns that come with that, which typically are not that high relative to the just basic skill that you can have. I think the quants do a great job in their own domain, but again, there's trade-offs to every single thing. And if you're going to be in that domain, great. But the edge there is just collapsing because of what we're seeing with all the tools that are available now, data and everything else. And so the most important thing you can do is to say, like, how can I actually do something that no institutional money manager can do? How can I take risk that they don't want to warehouse? Right? There is so much opportunity for that in financial markets. And here's the best part about it is there's still a misconception that, like, oh, well, retail is dumb money. This person is this money. What? It doesn't even exist anymore. I mean, you know how many, like institutional players in the market read people who are quote unquote retail? Do you know how many? It's insane, right? Like even the entire Substack space has blown up. Why? Because the institutional research has conflicts of interest and no one wants to read it anymore. Literally no one. And then people are coming over here and saying, like, oh, well, you have to realize retail is kind of dumb money. They're doing a lot of dumb stuff. You know how much money retail has made over the last 5 years? Insane amounts of money. And so is there attrition? Yeah, there's supposed to be. Do you know how much attrition there is in the financial industry? It's an insane amount. People are getting turned over all the time, especially risk takers. So again, you can always kind of try to anchor to these scapegoat arguments, or you can begin to operate with clarity and say, like, okay, what are the factors that exist? How do I develop an edge? How do I pull these moving parts together that we've talked about in the live stream, in the deck, in the dashboard that I'm laying out, in every single thing? How do we pull all those moving parts together and begin to build a framework for why things are taking place? And again, all the decks and charts and everything that we laid out, they'll all be at capitalflowsresearch.com. So if you're there on the website, just go there and download all of these resources that we're giving you on the stream today. They'll be there, send out an article in a little bit, and you can begin to build that base of knowledge. And we're going to do these live streams every day, 8:30 a.m. Mountain Standard Time, every single market day, and continuing building that base of knowledge. And so if that's the mindset you have, if you're feeling a little intimidated, that's perfect. You want to feel like, oh, this is a little overwhelming. I mean, what thing have you accomplished in your life that you were proud of that didn't feel overwhelming at the beginning? I guarantee you there's like nothing. Every single thing that brings a ton of value to your life is a bit overwhelming at the beginning. And then you get some reps and then you get some clarity and you realize, okay, I know where I'm going. And that's our entire goal. So those are all the main ideas for today. Before we end, there is a question that I wanted to share. And I want James to kind of pull us together with this kind of question so that we can kind of bring a lot of these ideas home. So here is a question from a subscriber that was asking. He says, I'm a new member watching the stream, and I heard what you said to come into the chat box to ask about what the next step for my particular life looks like. I'm not sure if it's the right place, but pretty new. I'm going to drop it here anyways. I guess the question is for both of you guys. Basically, I started from zero wealth, literally nothing, and I've built up a pretty nice cushion from working up through my career. Congrats on that. However, I am basically selling my soul time for money. I know that's just part of the bargain, and I understand most people have it worse. However, and maybe this is more for James, my position is I've basically got about $60K that I can invest. It's a great amount of money. And if it went to zero, I'd survive and be okay. But I guess I'm okay with risk because I really just want to escape the 9-to-5. I'm a corporate noob to all these things you and Flows have been talking about, but I'd say that I'm smart enough to learn and give it time and effort. My question is, along with reading all the material, watching every stream, how do I decide how much to invest, when to invest, how much conviction with the actual money amount I put to a trade. And if this is such a simple and vague question, this is a great question. It's not a vague question, not worth answering. This right here is the position that a lot of people are in. And I think this is like a perfect question to ask. So, James, how would you kind of answer this as we pull together all these parts?
Yeah, and honestly, he's in a really good position. You know what I mean? First of all, he's willing to put that out there. A lot of people aren't, right? Second of all, 60K is a great amount of money that you have. You have a job. I don't know where you live. I don't know, what your expenses are like, but it seems like you have a decent amount of runway, especially if you're saying if it went to zero, I'd be okay. I think that's great. But just because you have that and it could go to zero, I definitely don't think you should be risking that much. I don't think it's necessary. I think what you need to do is start thinking about, I would answer like the big questions for like my trading archetype type of mindset is like, are you a risk averse person? Or are you more risk on? Do you want to trade or do you want to invest? Because you use both words there. I don't really know what you're looking to do. Do you want to be a scalper? Do you want to swing trade? Do you want to just be putting money away in high conviction, long-term bets? If so, does that align with your risk taking, right? Have you ever lost money? Like, have you lost 10K before? Like, what did that feel like? How did you respond? If so, if it was really bad, all right, well, take that into consideration for now. If you've never done it, well, you're going to have to pay a lot of tuition and learn about yourself through that process. But, and maybe you could agree or not agree with this, Flows, is I think you could put a couple grand to work and learn a ton about investing, a ton about yourself, because I think people underestimate, and I've said this before, how quickly you can scale in this world, right? And what you need to do first is to prove that you're actually a winner. Like, it doesn't matter to me if you win, like if you take 1,000 trades and you win like 5 grand as opposed to 50 grand, like, I don't really care. Like, because if you've learned a lot and you've won over 1,000 trades and you've won 5 grand, I'm like, cool. You just built a massive foundation for yourself that you can now lever up and scale up. And 2 years from then, you could have 500K. But everybody wants it so fast right now, especially at the start. So fast. Like, let me just make that 500K first. And that's how you blow your 60K. You end up spiting trading. You say it's manipulated. You hate this space, and you unsubscribe to Capital Flows. So I don't think that's necessary. I think you just need to ask a lot of internal questions. Read the book like Mindset. I really like that book about early on about like thinking in abundance as opposed to thinking in scarcity. Don't rush yourself for the first 2 years. I think it's actually more beneficial to lose and then arc up and scale rather than to win and to have a God mode complex to start, which you'll bleed off and then have to learn everything anyway over a longer period of time. So I hope that helps. I think you don't need to put that much money to work. Really try a bunch of different assets, figure out the time horizon you like. Do you like options? Do you like stocks? Do you like perps? Do you like just investing in indexes? Do you have a network? Start meeting people, asking questions, write more of these messages to people. I think you'll be well on your way. A year later, you'll still have a bunch of money. You won't be, head in the sand, wishing that you never put all that to risk, and then go from there. That's probably my synopsis.
Yeah, I think that's great. I think there's this intrinsic thing of I have 50K, I have 60K, I have whatever. I see all these people making millions of dollars. I either need to make that amount or I don't want anything. And I don't want to go through the hard process of incrementally building up. I'd rather it just be a coin flip and I win or I lose. And if I lose, I'm just back to the corporate 9 to 5, which I hate anyway. If I win, then it's really cool. But, I would rather just lose it all than lose a little bit of it, which is wild to say, right? Because if you ask someone like, would you rather lose 60K or 1K? They would tell you, well, $1,000. But in this situation, you would almost feel better because then you would have closure. Then you would say like, okay, I can't keep doing this. I just have to go back and do this, right? But this is a great example of like, you've had some success in your life, right? You've been able to like pull together 60K, which is above average for any American in the United States, right? Your just average American does not have 60K in cash. So that's one, right? Which is indicates that you have the ability to have delayed gratification, right? However, when you have that amount of money, now you have to say like, okay, how do I function with this success now instead of trying to say like, well, how do I have how do I reset myself to zero so I just have to like build myself back up again or something like that, right? With this like scarcity mindset. And I think that it's just so key to orient yourself toward how could I, what James said, how can I prove to myself I'm good at what I do, right? And just say like, this is what's all counterintuitive of saying, okay, let me take a couple grand off of that. And if I can take this and make X amount of money with this, I'll prove to myself that I'm worth doing it with a larger amount of money. And then you begin to do that more and more and more, and you scale it up and you build confidence incrementally, right? Like that is so much less sexy than saying like just putting it all on black and let's see what happens, right? But that at the end of the day is what is going to produce long-term results. And like James said, figuring out who you are, what you're trying to do, why that's the case, those are all the stepping stones and the consistency and reps you have to build to begin to get to that place where you're saying like, oh, wow, I just made $1 million. I just made that, whatever that might be. Right. And I think that's just so critical.
And I think beware of self-sabotage too, because there's a lot of people out there who will get 60K and deep down, they won't even be aware, but they'll want to lose that 60K. They'll like being in the gutter. They'll find a way back to just being the 9-to-5, complain about everything, because that's where they truly feel like they belong. You need to shed that and start allowing yourself to be successful, to win a lot of money, to extract from the markets, and to be okay with it, and to feel like you deserve it. That's been a big thing for me too. Yeah. By the way, that's not something that just come easy to us.
I think it's all of us. And I think also, just to clarify, this doesn't have to be in the market, right? It could be anywhere in your life, right? Like we don't know what your life looks like and stuff like that. It could be, oh, you know what? I have this massive edge in this thing here in my local community, or I have this ability in this other e-commerce idea, or whatever it might be, right? It doesn't have to be markets. Understanding markets is going to help you in any domain of life, no matter what. But that goes back to like, well, what's your edge? What kind of lane are you in? How can you take advantage of that where you're at right now and just take one step forward? I think that's key as well.
Great question, though. Great question.
Great. All right. Well, everyone, thank you very much for joining Capital Flows live stream today. I think we covered so many good things. If you are just joining now and you're trying to go over everything, I laid out all of the macro thesis, and then James covered how exactly you want to take that thesis, pull it into a good framework for decision-making and execution, and then we went through all your questions, and we went through how can we break down and apply these to tangible scenarios and situations and the questions that you would have. And all of the resources for everything that we've laid out in this live stream, you can go back, watch the recording. All the resources will be on the Substack. Even if you're watching this right now, I'd encourage you to go through the recording again if you feel like you need to digest some of the topics more, and go through the slide decks on the website. Everything will be there. And we will continue laying out all these. I'll lay out more on the geopolitical side tomorrow morning, and we'll cover that even more. And then we'll have a special guest this week. Not going to say who it is, but we'll have a special guest this week. So appreciate everyone joining. James, thanks for being here as well as sharing everything as well.
All right, just remember to be like Winnie the Pooh out there.
What do we got? What do we have for Winnie the Pooh right there? Can we get a camera
angle? Looks at everything. He just looks like looks at everything from a great perspective. This guy. You know? Just get yourself a Winnie the Pooh attitude.
All right, guys. We'll catch you later.
See ya.